Welcome to day 3 of our summer boot camp. Very excited to be kicking off this day because today's a good one. Today's when we're actually starting to dive into different ways to trade in the stock market. As I already stated, we've already went over what the stock market is. We've already talked about what day trading is, why people day trade, perks of day trading. But today's the first day that we're actually starting to talk about strategies that you guys can start taking what you're learning and apply it to your trading. So, the different ways to trade the stock market. When we first say this, a lot of people may automatically be like, different ways to trade the stock market. We can trade the stock market different ways. Because what's the traditional way? The traditional way is you buy low, you sell high. How else can we trade the stock market? As a day trader, what else can we do to be able to make profit? Well, I wanted to put some of the most popular different strategies on how you guys can make money in this market. So we're going to dive right in on this. We're going to be talking about 9 different strategies I believe there are that that you can go ahead and make money in the stock market. So let's start with that traditional way. That traditional way is buy low and sell high. So when you think of stock trading, this is what you think of, right? Buying a stock low and selling it at a higher price. This is also known as going long on a stock. When buying low and selling high, one of the most important indicators to look at is the RSI. This indicator will show you when a stock is oversold and when buying volume can start moving back into the play. So it's going to show you guys when the stock is overbought and oversold. And we're going to be going a lot into detail on the RSI when we go over indicator lessons, which would be coming up shortly in the next few days. Now, buying low and selling high is what you always hear of, right? You want to find a stock that's nice and cheap. You want to find a company that's maybe just starting off, or find a company that has a lot of potential in the near future. You want to invest in that company, and at some point down the road, that company is going to give you a return. Now, the traditional way would be holding that stock for 6 months, for a year, for 2 years, 3 years, 20 years, right? And then at some point, you can go to your account and cash out the profit that you made as that company was able to build. But in day trading, when we are buying low and selling high, we are looking to get in at some point. Doesn't even have to be right in the morning. It could be at lunch. It could be in the afternoon. But we want to buy and sell at a higher area. And that does not have to be, right, a 6 months to a year. That's within sometimes minutes. That's sometimes within an hour. That's sometimes, a couple hours. It could be with even inside a couple seconds. These penny stocks are going to move so fast and so crazy. As in today. Today, you saw me live. I made $628 today. And I was in a play for how long? Less than 5 minutes? Less than 5 minutes. I was able to make $628. And that's because these plays like to spike. And these plays like to rip. And these plays can lead to some very, very profitable moves. So this is what I do a lot of the time, guys. This is where I base a lot of my trading off of. The traditional foundation of buying low, selling high. Right? Now, again, a demonstration of going long would be right here. We like to buy a stock nice and low. And these candles, each candle, every single blue or red candle can represent different things, right? We can change those time frames. Though each candle can represent 1 minute. Each candle could represent 3 minutes. Each candle could represent 5 minutes. Or each candle could represent a day, right? We don't have in this example if it's a 1, 2, 3, 5, daily chart. But each one of those candles, let's say it's a daily chart. Well, again, that means that person is most likely going to be looking to hold for a few months. If that's a 1 minute chart, right, that person would want to be holding for maybe 30 minutes or so to be able to make that profit. It doesn't matter how long it is, as long as we can buy low and sell at a higher point to be able to make some sort of profit. Now, what would be the complete opposite of buying low and selling high? Well, that would be shorting, right? Shorting a stock is when the shares are sold and then of the proceeds and then credited to your account later on. So sooner or later, you must close the short by buying back the number of shares. Now, this is called covering and returning them to your broker. If the price drops, you can buy back the same, or excuse me, you can buy back the stock at a lower price and make a profit on the difference. All right. So I know that gets a little bit confusing. So shorting a stock is when the shares are sold and the proceeds are credited to your account. Sooner or later, you must close the short by buying back the same number of shares, which is called covering, and returning them to your broker. If the price drops, you can buy back the stock at the lower price and make a profit on the difference. And I know, especially as a new trader, this is the thing that confuses people the most. It's like you're buying shares back and crediting it to your account and you're making money as the stock falls. How does this work? Let's just simplify it. Let's just make it as easy as possible. Simple enough, guys. You are just betting against the stock. You are betting that the stock will fall and you profit as the stock crashes. So if you want to know, again, what shorting is, and you don't want to get confused with, buying back and, crediting, if you want the most blunt and the most easy way to think about it, you are just betting against the stock. As the stock falls, you're going to be making money. This is a great technique used in penny stocks, as when these stocks are pumped on up, they crash right back down. So we are going to see a ton of pump and dumps. We are going to see a ton of spikes, and we're going to see a ton of falls back on down. Every time a penny stock usually spikes back on up, it comes back on down. There's not going to be many times that we see a penny stock shoot on up and just keep going up and going up and going up. Maybe have a little pullback and keep going up, up, up. That rarely / never happens. At some point, that stock's going to be coming back on down. So people love to short, right? Because when you short, it's kind of like, that stock's going to be coming back on down. The only issue is we don't know how high it's going to go up to before it starts coming back on down. And we're going to be going over some examples about, why it's so dangerous, right? Think about it. Why would shorting be so dangerous? We already talked about shorting. Let's say the stock runs up to $1. The stock goes from 50 cents and runs up to $1. You put a short order at $1. So now you need the stock to fall on down to make money, right? So if you short a stock at $1 and it falls and you have 1,000 shares and the stock falls to 80 cents, you make the same amount as if the stock went from $1 up to 120 and you were on the long side. If you have 1,000 shares and you were going long on the stock and it goes from $1 to 120, how much would you make? You would make $200. Now, if you short a stock and it goes from $1 to 80 cents, that's still 20 cents. Again, just in the opposite direction, and you want that because you're shorting. So that's still $200, right? And you might say, well, Dek, that sounds great because there's so many times I miss out on plays. There's so many times that these stocks, spike and I can't find them. I can find them after they spike because they're all over the news. So this is great because after the stock spikes, I could just start shorting it as it falls. And that's what a lot of people do. A lot of people have trouble finding the best top gainers. A lot of people have trouble finding what stocks are going to spike. A lot of people have trouble finding what play is going to be the best one of the day. But after that play develops, after that becomes the best play of the day, it's very easy to be like, okay, you know what? That's the best play of the day. Well, I can't buy it now because it already spiked so high. So what can I do? I can short it all the way back on down. And it's a very profitable way. And a lot of people are going to be consistent and make a lot of money doing that. But there is one major flaw. Shorting is extremely risky because numbers go forever. Numbers go forever. And what does that mean when I say that? Well, if I go long on a stock and I buy 1,000 shares at $1 and I'm going long, which means I want it to go up, and the stock starts dumping and falling and falling and falling and falling, how much can I humanly possible lose, right? How much can I lose? I can only lose $1,000 because the stock can't go below zero, right? It can't go below zero because if I buy 1,000 shares at $1 and it starts falling and it falls and goes all the way out of business, that would be $1,000, right? But I can't lose any more. Now, let's say you have a $2,000 account and you put 1,000 shares at $1 on the short side, which means you're expecting it to start falling to 90, 80, 70, whatever, and you can make money. Well, what happens if that stock goes from $1 to $2? Well, now you're down $1,000, right? You only have $1,000 left in your account. Well, what happens if that stock goes from $2 to $3? Well, now, again, you just lost your whole entire account. What happens if that stock goes from $3 to $4? Well, if you're still holding that short, and your broker has not cut you out, which they should, but sometimes it happens, now you owe your broker $1,000. It doesn't matter that you don't have any more money in your account left. You borrowed. That's what shorting is. Remember, the shorting definition is you borrowed these shares, and when you sell them, you have to pay for the proceeds, which now they're worth $3, right? So $3, $4. Now you owe your company your broker $1,000. Now let's say again the stock runs up to $5, $6, $10, $20. You could be a person who only had $2,000 in your account, and now you're $20,000 in debt. And you'll see it every now and then. We'll have stocks go from $1 and spike all the way up to $50. We'll have stocks go from $1 and spike all the way up to $100. And people who shorted 5,000 shares, 3,000, 10,000 shares, $500,000 in debt. Could be a regular person, works a 9 to 5, just short stocks every now and then, got caught up in one of the worst breakouts there is. And what happens? That person is now, doing what? $300,000 in debt. You're going to see it on the internet every now and then that someone's going to throw out a GoFundMe account saying, please help me. I lost everything. I never covered my short. So while shorting sounds awesome because you guys can go ahead and you guys can find easy spikes, and after the spike happens, we always see these stocks, have these pullbacks. There is every now and then, right? Probably 1 in every 1,000, 1 in every 500, where the stock is just going to keep going and going and going and going, and it's going to turn into what we call a supernova. And it's where a lot of people start losing money. So you need to be very careful on your shorts, and you guys can study shorting a little bit more. But it's one of the main reasons why I personally like to go long on plays. It's one of the main reasons on why I always stay long on plays. But there are a few great shorters in chat as well, right, who you guys can look up to, especially if you guys are beginning and looking to short, because shorting is very profitable. I'm not trying to turn you off of it. I just want to show you guys the advantages and show you guys the cons, right? So very, very important. What else? How else can we make money in the stock market? What's a strategy that traders like to use? Well, traders like to also play a thing called earnings reports. So what is an earnings report? Well, an earnings report is a quarterly filing made by public companies to report their performance. Earnings reports include items such as net income, earnings per share, earnings from continuing operations, and net sales. A lot of traders study companies that will have a good earnings and buy shares before the company releases its report. If the company releases good earnings, and their share price will rise as investors buy into their thriving company, right? So break it down, make it easy. An earnings report. An earnings report is going to come out 4 different times throughout the year for each quarter. There's 4 different quarters. Each quarter is 3 months long, 12 months in a year, right? So an earnings is just going to give us investors a performance update on how they are doing, right? We're going to have 4 different earnings report, and then we'll also have an end of the year earnings report that kind of wraps up the whole entire year. Now, how can this help us make money? How can we make money by playing earnings reports? Why do traders play earnings reports? Well, let's say a stock is very low in price. It hasn't really been doing too much. And let's say an earnings report comes out where the company says, hey, we just increased our sales 200%. We have seen new partners come in. We have seen a lot of interest in us. And this market that we're currently in is currently thriving. Well, why would that company put that out? Well, because they want to sound good. They want investors to put money into them, so then they can go do whatever they want to do. So a company wants to put out good earnings, so it sounds good and attractive for people, investors, to put their money into them. So why would a stock spike off this? Well, imagine all the people that are putting their money into this company. If we have a company that's nice and low, that hasn't spiked, that hasn't moved, that people really aren't paying attention to, and all of a sudden they can't come out with a good earnings report that says, hey, we used to be in debt, now we're not. Our earnings, our revenues are now up 100%. Last year they were down 20%. We just had a great partnership. We've added over 30 different employees, and we have an agreement for a $5.2 million contract coming up, right? These are all things that would be coming up in some sort of earnings report to help, again, traders, you want to buy into it, which would raise the stock very high. Now, earnings. The thing about earnings, guys, they come out in pre-market and they come out in after hours. Now, I am not a huge earnings fan because earnings, there's two different reasons why I'm not a huge fan. Number one, earnings are usually only pre-market or after-hour plays, which means that if a company comes out with an earnings report in after hours, which is after the market closes, which is from 4 to 8 o'clock at night, the company would come out with an earnings and the stock would gap up overnight. Usually after the stock gaps up, that's usually it. There's not really too much that's left after that. It's not usually a big spiking type of press release. It's more of a gap up overnight, or if the company comes out with earnings in pre-market, which is from 7 in the morning till 9:30 when the market opens on up, the stock most likely would spike in pre-market, and then that's it. Earnings usually don't spike very hard during the day. They're more after hours or pre-market plays. And that's not, a total bad thing because you guys can still make money. But how do a lot of people make money in earnings? Well, a lot of people get a little gambly in earnings. And that's why I'm not a huge fan of earnings, because people like to take a lot of chances. People like to guess. They like to guess what? They like to guess how the earnings are going to be. Are the earnings going to be good, or are the earnings going to be bad? Over the last quarter, over the last 3 months, how did this company do? Well, the only people who honestly know how the company did are insiders, the CEO, the vice president, right? People, board of directors. Those are really the only people. The analysts that they have, on Yahoo Finance typing out for penny stocks if they're good or bad, don't really have that great of an idea. Can you dive in and look at, some of the statistics of the company? Yes, right? Can you look at past performance? Yes. Can you look at this, and follow along, all their press releases, and you guys can see how much they have coming up or how much they've grown? Yes, you can see things along those lines, but there is still not ever a 100% chance you know which way these earnings are going to go, and they could completely throw you off. So there's two different ways that traders play earnings. Number one, let's say stock XYZ has earnings coming out tonight. Stock XYZ has earnings coming out tonight right at 4 o'clock. I can A, buy in, right, before 4 o'clock. Let's say I buy in at 350. And why would I want to do that? Because I'm hoping the earnings are going to be good. I buy in on stock XYZ at 350. I know earnings come out at 4 o'clock, and I'm hoping the earnings are good. If the earnings are good, the stock is going to gap up tomorrow, and I'll be able to make money, right? But what if the earnings are bad? What if I hop in on this play and all of a sudden the earnings are bad? If the earnings are bad, well, then the stock's just going to drop, and I'm going to get taken down with it. I got to try to scramble my way out of that in after hours. But other people are going to be selling it. So other people are selling it who guessed too early. People who have been holding the company are going to be selling it, and you're going to be losing money, right? Or what you can do is wait for the earnings to come out, be aware that the earnings are going to come out, and then you can get in. Okay, stock XYZ earnings come out at 4 o'clock. Let me be ready for it. Let me skim it and read it as quickly as possible. And then after that, I can get in. What would be the pro about getting in before the earnings come out? You're taking more of a risk. With more risk comes more reward. If you put in and you say to yourself, hey, right here, we have this company, right, XYZ. We know earnings are coming out at 4 o'clock. If I buy, right, if I buy a 355, 350, and they're good, everyone's going to start buying in on that play, and I'm going to make a lot of profit. If I wait until after the earnings come out, I'm one of the people that's buying after the earnings, trying to get in on the good news. I could still make money, but maybe just not as much as if I bought in early. But reverse that, if I'm in on it before the earnings come out and they're bad earnings, what do you think is going to happen? The stock's going to drop. It's going to collapse. Now, if I'm not in on that play and I read it and I say, whoa, that's bad earnings, I don't need to buy it. I don't lose any money. So the person who waits until the earnings comes out doesn't lose any money, but can't make that much money. The person who takes a little bit of the gamble and buys beforehand can make the most money, but it can also lose the most money, right? And that's how earnings reports work a lot of times. People don't know if they should be buying beforehand or buying after, and that's why it gets a little bit tough at times, right? So, what does like an earnings report really look like? What do traders like to see in an earnings report? Well, here's an example of an earnings report, right? We have China Ceramics announced the second half and full year financial results for 2018. So, if we look into this, reading right at the top, we have operating results were affected by the following significant items. Sales in the second half of 2018 sharply decreased due to an unexpected slowdown in China's real estate sector. Does that sound good to us right there? No, not really. Right, provision for inventory impairment was $56 million. The 6 months ended December 31st, compared to a reversal and inventory impairment of $2.7 million. Right, they're just giving us some operating results. Let's go to the second half 2018 summary. Revenue was $20.8 million the 6 months ended December 31st, 2018, compared to the $73.2 million the same period of 2017. So what we have right here is revenue was $20 million this year. Last year, it was $73 million. We had a gross loss. We had a net loss. We had a loss per share, right? So if we look all the way to the bottom, during the second half of 2018, we experienced difficult market conditions as compared to the same year of 2017. Our revenue decreased 71% for the second half of 2018 due to a 72% decrease in our sales volume. However, after adjusting the asset write-offs of our cash flow was modestly positive for the second half of the year despite the market slowdown. So does that sound like a positive earnings to you guys? Does this seem like something we want to jump into? No, right? But imagine if we said to ourselves, hey, all right, CCCL, this is a play that we're going to jump into right now, right? We're going to jump into it. We have earnings coming out. Earnings are coming out this morning. Let's hop in on this play, and hopefully the earnings are good. CCCL, this didn't work out very well for it, right? The CEO hops on, says our revenue decreased, and tries to keep spirits alive. It's like, however, we had modestly positive for second half, right? So this is not what you really want to see, but this would be an example showing operating results, a second half, fiscal year, talking about where our revenues are currently at. Right, so this is very important that you guys can understand and you guys can read. And I know again some of it's confusing, but it's really you just break it down. Compare the first year to the second year. If I'm seeing revenues of $20 million in the first year, and then I see $3 million currently, which one had more? $20 million the first year. So I mean, this year's not as good as the first year. That probably means things are going to be falling on down. Right? So again, it may sound confusing at first, but once you get the hang of it and you kind of know what to just compare and you could just read the CEO statement, we experienced difficult market conditions. It's not very good, right? So you look for positive words, you look for negative words. And we'll be diving more into that into the future. So what else can we be doing, guys? We can also look to swing trade, right? Swing trading. So what's swing trading? Swing trading is a short-term trading method that can be used when trading stocks and options. This can be holding overnight for gap ups or gap down, for holding a stock for a few days thinking it will go on a small run. Swing trading can lead to very easy profits if a stock is a strong positive or negative momentum. So swing trading, guys, what is swing trading? When we say swing trading in chat, it's going to be meaning holding a stock overnight. All right. So when we're commentating and I'm live streaming my trades on Tradecaster and I'm doing everything, and I say, hey, let's look for swings for the night, I'm talking about holding the stock from the end of the night to the start of the day tomorrow. Now, why would we want to swing trade a stock? Well, because news can come out on that stock overnight. The stock may have had good momentum at the end of the day. The stock has a good chart set up. Stocks can gap up and gap down overnight. I know that's a confusing thing when you guys first start because you're like, how? Right? Well, you don't change through the New York Stock Exchange or the NASDAQ. You're actually changing your shares through your broker. So if I'm on, let's say, broker A, right, and someone's on broker B, and I want to sell my shares or I want to buy my shares, let's say buy, and I want to buy stock XYZ, right? I see news comes out on XYZ after the market's closed, after 4 o'clock. And I can go on my broker and I can put to myself, hey, the stock was at $4. I want to buy the stock at 450 because news just came out and I want to get in before the market opens tomorrow. I could put a bid, a buy order, right at 425 or 450, and if there's someone out there in the world that sees that order that says, yeah, I'll sell you my shares. I've been in on this place since 375, right? That person went from 375 up to 450, right? You just got in at 450. The stock closed at $4, or let's say right around that area, and now what happens? Well, now the stock's gapping up. Now let's say someone else says, yeah, I want to buy in right now too, right? For that good news. They put an order in, or someone says, well, I'll sell my shares if you guys want them at 475. It seems like news came out. I'll sell my shares to you guys at 475 if you want. Someone says, yeah, I'll take those shares. I know the stock may go up more tomorrow. So someone takes those shares. And someone says, well, I want to buy more. And this person says, well, I'll sell you mine. All right, at what price? Well, $5. I'll sell you my price. All right, I'll buy them at $5. Now the stock's moving up. So swing trading, guys, as you can see, the stock went from $4 to $5 just, right there alone. Now, again, multiply that by hundreds to thousands of traders. And I also multiply that by, when news comes out. News comes out, everyone does that. They're looking to get in the play as quickly as possible because they're trying to beat the mob, the majority of buyers, the majority of traders before they see that press release so they can get in and start making some profit off of it. So swing trading, again, when someone says they're a swing trader, they could be holding more for a night. They could be holding for a few days or a few weeks. But when we're talking about, a group of day traders say, hey, let's swing trade a stock, we're usually saying we're only going to hold it, most likely overnight for a gap up or gap down. But 1 or 2 days, still counts as a swing trade as well. So if we want to look at a swing trade, let's say, this would be each one of these candles represent, $1, if we want to think about it that way, right? Well, each one of these candles represent $1. Now, if we want to, we can go ahead and we could swing trade at the bottom lows. Let's say, okay, hey, we have, a nice little uptrend going up through this play right here. I see that, this stock is coming down to a low right here. Well, I could swing trade the stock, and I can swing trade the stock and maybe hold it for a few days, right? And then sell it later on. I can short swing it. You can short the stock and hold it for a few days and sell it down low for a profit. And you can just keep doing that over and over and over again, right? There's going to be some graphs coming on up where you'll be able to see big time gap ups, big time, pops. And that's where you can hold it overnight. So we have gap ups or gap downs, or you guys can hold it for a few days looking for a nice climb. You can sell it, you can short it, you can sell, buy it, you can sell it. So you can kind of just be going back and forth, holding these plays for a few days, getting in and out. And again, this kind of goes back. We don't have to be traditional. We don't have to buy it right here and hopefully 6 months later sell it here for a perfect trade. If we know that this is going to be a bounce play, we can buy it right here. We could sell it up here, right? If we think that's good, let's buy it back down low, sell it up here. We don't need to, again, hold the whole entire play. We're being stock snipers, right? We're getting in on these plays at the best area possible, and we're selling them for a profit, right? Would it be nice to hold right here, to ride it all the way up here? Absolutely. But we may not see that. We may not notice that. So what we want to do is, hey, we know a bounce play is coming. Let's make our money and let's get out, right? So it's very important that you guys are constantly, understanding which strategy may be the most profitable at this time. Because you may say to yourself, well, Deck, I like going long. I like swing trading. I like earnings. I like shorting. Which one do I have to play? Well, do which one fits best for that day. Do which one fits best for the current market conditions, right? So what else do people like to do, to make money, right? The long-term invest. We talked about going long, and this basically is the same thing, going long, that long-term investment. Holding a stock long-term is one of the safest ways to make money in the stock market, but it will also take the longest. When holding a stock long-term, you want to look into the company's filings, their PE ratio, future expectations, current programs they're working on, and more, right? I'm not a long-term investor. I'm not a huge fan of holding a play long-term, to try to make some sort of money, 20%. I'm a fan of holding a stock long-term, maybe in the penny stock world, if you expect a press release to come out on it. And then, you could make, more than 20%. But a lot of times, long-term investors, they buy in a stock on that whole entire year. As I said, you're looking for somewhere between 10 to 20% return, right? 10 to 20% return. It's like we had a 15% return today alone. I was able to make $683 within 5 minutes today. I don't want to wait 3 months to see that. I don't want to wait, 6 months, a year to be able to see that. I want to be able to get that right away. But obviously, getting it right away, there's going to be more risk. Obviously, getting it right away, there's going to be um, more consequences. And how do we limit those consequences? How do we limit those risks? Well, we need to study. We need to put in work. People say sometimes day trading is dangerous. Why? Because stocks move so fast. And with stocks moving so fast, you can make a lot of money, but you can also lose a lot of money. So how do we limit our risk? Well, we need to be disciplined. We need to study. Kind of what I talked about a lot on day one. And when we talked about, on day two, where I said you can't be a fantasy trader. If you're here expecting not to do any sort of work whatsoever, you're not going to be good. And that's, again, why a lot of people aren't good at day trading, because they just want money right away. They're blinded by greed. They don't study. They don't do anything other than just trade, 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 trade. Wow, I lost everything. This is stupid, right? Instead of the person who puts in work, studies, gets everything done, paper trades, and then makes, $500, $1,000 a day. And they're the people saying, oh, yeah, you should definitely day trade. But obviously, they don't realize how much work you put in. And again, these are the things I'm telling. So hold on a stock long term, right? This is kind of, a graph we would see a lot of times when someone says, oh, yeah, I'm checking out my stock. Oh, I've been holding this bad boy for, the past, 2 years now. And we're just seeing, a stock, go through its course, some ups, we have some downs. Obviously, this has been a lot of time someone been holding this play. And, hopefully, again, you're looking to buy low, sell at highs. But that's even another thing that, if you purchase, obviously, the wrong stock, if you get in on the wrong play, imagine buying the stock up towards around 215 right here. And the stock, starts falling, falling, falling. And a whole entire 7 months to a year passes. And you're only back up to where you started. That's like another reason why I'm not a huge fan of long-term investing. If you don't get a good entry, you may go a whole year just to get back to where you started. And that's never fun, right? That's kind of pointless when all this time that you could be day trading stocks on those nice spikes and those nice rips. So what else can we do right here, guys? Well, we can look for bounce plays, right? What's a bounce play? Buy a bounce. It's a strategy that focuses on buying on given securities once the price of the asset falls towards an important level of support. Traders who buy a bounce attempt to profit from a short-term correction or bounce off the identified support. All stocks have levels off support where they have bounced in the past. Finding these areas will lead to easy buy markets where the stock will turn around and start moving on up. All right, we're going to talk about this in the future, guys. But there are 3 different levels of support. And what is support? Support is a price point that the stock is going to bounce at. All right? These 3 different levels, a little, heads up for you, are going to be natural support. We're going to have previous chart history support. And we're going to have detailed support. Now, these are all price points where as the stock comes down to, it'll bounce off of. So for instance, if the stock is at 150 and it comes down to $1, we can look for an entry at $1 because we know it's going to bounce off $1. It goes from $1 up to 125, 25 cents. Let's say we have 1,000 shares. That's $250 in profit right there, right? Let's say the stock goes on a very big spike and it goes from $2, spikes up towards around 225 for a minute, consolidates, then it runs up to 250. Well, we have natural support at 225. Also, a little bit of consolidation, past chart history right here, comes back down to 225. We can look for a bounce play off that area. That's where that stock's going to bounce at and move back on up. I know that sounds confusing if you guys don't understand it yet, but when we have our dip buying, our bounce plays, this is what we're looking for. We're looking at where's the stock going to fall, consolidate, bounce back on up, right? And a lot of times we can figure this out from the past. All right. So a lot of times you can figure this out from the past about where these stocks are going to be able to bounce at. So, if we want to look, we have our first, dip buy right here, right? We buy right here. The stock starts spiking on up. Well, as the stock starts falling on down, we can say to ourselves, where's the next buy area? Well, charts usually have our old support will hold up as new support. So if we, again, bounced it right here, stock, traders bought in right here, it moved on up, where do you think it's going to bounce again? Same area. Again, you can just follow this black line right here. Same area where traders bought it right here is the same area that traders are buying it right here, right? The stock moves on up. This would be a bounce play right here. right? This is old resistance. This top right here, see this top? Old resistance. Let's drag that over. Holds up as new support, right? Stock goes on a nice rip, starts coming back on down. Finally, we get a nice bounce play, right? Because it also had a nice little bounce right here. Has a nice little bounce right here. Old resistance right here. Some old resistance right here. Stock shoots on up, comes back on down. Whoopsie. Let's go back. Stock shoots on up, starts coming back on down. Bounce play right here. Shoots on up, comes back on down. Bounce play right here. Shoots on up, comes back down. Bounce play right here. So notice all the little dip buys. The dip buys, the bounce play, whatever you want to call it, right? This is areas where you can get in and moves up, you make money. You get in and moves up, you make money. It's very profitable. And whenever I'm late to a spike, this is what I like to do. So if a stock ever starts spiking on up, I don't want to buy after the stock just went from $1 to, let's say, $3. The stock's going to fall soon. I'd rather wait for it to fall, bounce, then let me get in. From $2 up to $7. If I missed out, don't buy at the top at $7. Wait for it to start coming back on down. And once it comes back on down, then you can bounce it right here, right? Then go, from that $2 mark back up towards $7. It doesn't matter if you go from $1 to $3, or it doesn't matter if you go to $3 to $5, or if you go to $3 to $5 here. It's all still a $2 move. You're still making the same amount of money if you have the same amount of shares, right? It's all the same still. So don't get, frustrated if you miss the first bounce or the second bounce or the third bounce. You can make even more money on this biggest rip right here. Look how big this spike is, right? And that's okay. So what else do we have here, guys? We have play trend lines. Today we had a great example, right? And this is one of the most common. This is one of the most easy. This is one of the most basic things that you guys can do, which works. It works a lot. And a trend line is a straight line that connects two or more price points and then extends into the future as an act of support, right? By connecting the bottom of each candle on a stock chart, you'll be able to see a common pattern or trend. By following this trend line, you'll be able to predict where the stock will be bouncing next and where it may be crashing. So a trend line is simple enough of just connecting the dots. That's all we need to do, guys. We just need to look at where was all the dip buys, and then we connect them all together. So trend line playing really just comes from, trying to find these dip buys and connecting this dot to this dot to this dot. And we could put an uptrend on this play, right? And we could just find this dot and connect it with this dot. We could connect it, and we could find this dot and connect it. And we could see the daily uptrend. Now, trend lines are so easy because anything that is above the trend line is bullish, and anything on the bottom side is bearish. Now remember, we've gone over this and we've talked about this, right? And we've said to ourselves, hey, anything above the trend line is considered bullish. Anything below the trend line is considered bearish. Bullish means go up, bearish means goes down. Bullish is more buyers, bearish is more sellers. Bullish is going long, bearish means shorting. So notice this. All you got to do is find the daily trend line and you're good to hold. 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 Sell it here. Stop loss here. Look to short here, right? I think about it in a very childish, very kind of dark way sometimes where it's like, think of this right here, this line as basically the drop off. And what do I mean by the drop off? Well, imagine this is all shallow water. This is all shallow water right here, anything on top. And this right here represents the drop off. And all these candles are little seals, all right? What happens when the seals are in shallow water right here? They're having a good time. They're having fun. They're slapping fins, barking it up a storm, doing whatever seals like to do on a nice day. But the moment you go into the drop off and you start getting into the deep water, what happens? Sharks. Sharks start coming on in. It's feeding time. Sharks can't go in the shallow water, right? They got to murk at the bottom. And right when, again, they start seeing the seals go into the deep water, they come flying off, right? And then what happens to that water? Oh, it gets awfully red, right? So that water is going to get awfully red as this thing starts coming all the way back on down. Those seals are getting dragged down to the bottom. All right, I told you it was a little dark. All right, but, just very easy way to, be able to see that. So again, trend lines, connect the dots. You're all good to make some easy money. Now, this is one of my favorite ways to make money, guys. One of the best ways to me. That hype and momentum. Woo! This is one of my favorite strategies to be able to make that big time money, right? So, hype and momentum, where does it come from? News and volume is what brings in hype and momentum. And I'm going to say that again. News and volume, hot press releases, and a lot of traders is what brings in hype and momentum for day traders. When a brand new positive press release comes out on a company, expect big volume of buyers who push this stock up all at once to start moving on through. These stocks are typically low float stocks that can easily be moved. If you find these press releases early enough, you'll be able to ride that hot momentum and pick up the stock and profit. So again, you'll be able to see these plays go on crazy rips and crazy runs from news. All right. Now, what would a crazy rip and a crazy run, look like? Well, as we see right here, we'll be able to see like this type of play. A stock that goes from $4 and spikes all the way up to $60. $4 all the way up to $60. RKDA. RKDA came out with a press release. I believe they're a farming company, and they came out with a press release talking about their wheat. And they said their wheat, is something that we've never seen before. They also said they're going to be one of the biggest wheat, companies in the nation. And RKDA went insane from the hype and the momentum. And this is what happens, right? Think about it as you're on top of a hill. You're on top of a hill and you get a little snowball and you roll it down that hill. What happens, in all the movies and such? You roll that little snowball, it gets bigger and bigger and bigger and bigger and bigger and bigger and bigger until that thing is like the size of like an Indiana Jones boulder chasing after you, right? And that's what happens with this momentum. RKDA, okay, I'm going to buy it, right? Let's say that. Let's say I see RKDA's news and I say, all right, I'm going to buy it, right? And you can say, oh, yeah, I like it too. I'm going to buy it. And someone goes, yeah, well, it's starting to move a little bit. I'm going to buy it. Someone else goes, I'm going to buy it. And someone else goes, I'm going to buy it. Well, I'm going to buy it. I'm going to buy it. Ah! Right? And it starts going absolutely crazy, right? These moves start going wild. And that's all it takes sometimes, that hype and that momentum and these crazy rips and these crazy runs and these ginormous, climbs, right? So hype and momentum can really take these plays on off, a lot. Where we're seeing these huge moves. I apologize if you guys hear any like buzz in the background for a moment or two. Outside my apartment, they're doing some construction, so that was just that noise. But someone with a good old power saw. But I'm pretty sure I don't even know if you guys can hear that. But if you guys do, it'll be done in a few seconds. Now these hype and momentum plays, going absolutely crazy, and these are the ones that I search for. Because just imagine how profitable you can be. Imagine you have a $5,000 account and the stock goes from $4.91 and goes all the way up to $65, right? And let's say you buy 1,000 shares at $5 and you're able to hold it this whole entire run. Just with a $5,000 account, right? You were able to make $60,000 in 2 days. $60,000 in 2 days. Imagine if you had a bigger account. $10,000, $15,000, $20,000, and you were able to nail the meat of this trade, right? You're looking at $300,000 plus in the matter of 2 days. You wonder how people get rich in the stock market? You wonder how people are able to afford the things that they afford and go to the places that they go to, right? It's from these type of moves, right? People aren't becoming millionaires by investing in long-term plays and holding for 3 years, 4 years, 5 years to make 20%, right? They're finding these plays that are leading towards giant rips and giant runs. That's what you guys need to be on top of, and that's what you guys need to be aware of. So we're going to be teaching you guys a lot about these plays, obviously coming on up. All right, we're coming down to the final one right here, guys, which is scalping. Scalping is a trading style specializing in taking profits on small price changes. Generally soon after a trade has been entered and has become profitable. Scalping deals with traders buying large bulks of shares at a certain price and selling their shares only a few cents later. Since they bought so many shares, those few cents that moved may lead to hundreds to thousands of dollars. So, what would be an example of scalping, guys? Scalping. Let's say the stock is at $1 and you have, a good account size. You buy 10,000 shares, which would cost you $10,000, right? Now, if you have 1,000 shares, right, every time that stock moves a penny, you make $10. If the stock goes from $1 all the way up to $2, you make $1,000. Let's say you have 10,000 shares. It's no longer $10, right? If you have 10,000 shares, every single time it moves every time it moves a penny, you make $100, right? And every single time that this stock goes from $1 to $2, you make $10,000. So if a stock goes from, let's say $1 to $1.10, you'd be making $100 with 1,000 shares. Now, if you have 10,000 shares, you're making $1,000. And that's, the point of scalping. Is on scalping, you're kind of just looking for very quick, short moves where basically you try to find an area where you believe the stock's going to bounce at, or you believe the stock's going to move at, and you get in a ton of shares right here and you sell them, at a very quick price right here. Right? And you could, buy them again right here and sell them right here. It's not like the stock's going on any sort of crazy dramatic moves. You're more, again, doing what? Just trying to get in quick and sell very quick. All right. These are for people with bigger accounts, people with a little bit more experience, but it's, for maybe a slow day where you're not seeing too much other than maybe a few couple moves. And you're just like, all right, this stock is going to get probably at least like a 5-cent bounce. Yeah. Let me put in 10,000 shares, make $500 and, I'll be all set. So these are the top strategies that you guys need to focus on. Again, they are scalping. They are hype and momentum. They are play trend lines. They are bounce plays. They are long term. They are swing trade. It is earnings reports. It is shorting. And it is going long, buying low, selling high. All right? So I wanted to take this time, nice 46-minute lesson on day 3, and talk about the different ways that you can trade in the stock market and be a profitable trader. You guys are definitely going to want to find 1 or 2 of these that you like the most, that you can start learning more about. For me, it's obviously the buy low, sell high with a mixture of some dip buying, some trend line playing, but really hype and momentum. That's where I like to be at. So, you don't just got to pick one and that's it. But, what I really like to do, buy low, sell high, find stocks with hype and momentum. If I miss the big spike, well, then I'm going to be looking for a dip buy or even hype and momentum. You can put on trend line. If the stock is going crazy and is going to be multiple days, then you can swing trade it. And then you can short it back down if you want to. I mean, you could really just look for every single one and throw it all in on the same play. The more techniques the better you can do, because the more opportunities you guys can profit. So that concludes our day 3 boot camp. We're going to be progressing with day 4 tomorrow. I'm excited to keep this going every single day and keep you guys educated, learning, getting more and more towards it. So awesome job. Enjoy this lesson, and I will see you guys back here for day 4 tomorrow.